How much risk should I take when investing? A question I get asked most weeks and is an integral part of the conversation that I have with my clients in my role as a financial advisor. Every day we take risks, from getting in our cars to crossing the road, from eating those suspect leftovers to going in the loft. Yes, that is a hole created by me falling through the ceiling getting out the Christmas decorations. Another quick look? I'm fine, thank you for asking. Investing your hard-earned money is no different, and we have to make a decision on how much risk we should take. But the first thing to understand is that every single decision you make with your money carries a degree of risk, all the way from that gamble on the budget brand of cheese from your favourite Scandinavian supermarket, all the way to investing in the stock market. Every stock, bond, mutual fund and ETF that you might look to buy carries a differing degree of risk. And when you're new to this, it can be pretty overwhelming. I have 4 very simple steps that I want to take you through, which will help you decide on how much risk you should be taking. And it is in fact these very 4 steps that I go through with my clients. And I'm actually going to walk you through this as if it were a decision that I were making about some of my own money I'm looking to invest. Right, let's begin, shall we? Step 1 is assessing risk required, or establishing your goals. This is all about understanding why you are investing. People invest money for a reason. What is your goal? Big goals like retiring one day, or smaller, more short-term goals like building a pot to buy your first home or help out your children. Whatever your goal is, it's important to identify it specifically, and you need 2 pieces of information for this. How much do you need, and by when? Quantify it, put a number on it, and a date. In truth, goal setting is more difficult than it may seem because you are trying to answer some pretty big questions. Like, if retiring is your goal, working out when you want that to be and how much you need when you get there can be a tricky question. And even then, when you've worked this out, next you have to come up with some priorities. Which goals are more important than others, so you can set aside your limited pounds and pence towards them. The truth is, you probably won't be able to answer these questions perfectly, but that's okay. Give them your best guess and fine-tune later. One of the reasons that this is the first step is that typically, the longer away your objective is, the higher the level of risk you might be able to take in the hope of higher rewards. And the same generalisation can be said about the shorter the time horizon for your objective, the less risk you might want to take. For example, I know I want to retire by the time I'm 50, so in about 16 years' time. And let's say I need £1 million to make that happen. So now I know how much and by when. Now that's a little while away, so it would begin to push me up the higher end of the scale. So what's next? Step 2 is capacity for loss. In a nutshell, how much can you afford to lose? You need to ask yourself some what-if style questions here, like, what if you hadn't eaten all that cake? Would you have still fallen through the loft? Questions like, what if your investments fall by 20%? How would that affect your day-to-day finances? Would it have a material impact on your standard of living right now? If the answer is yes, then you might want to dial down the risk. Often the answers here lie around, again, how far away is your objective? The further away your objective, the short-term bumps don't matter so much because they tend to smooth out over time, which means that these investors can potentially stomach a higher level of risk in the hope for achieving a higher reward, although nothing is guaranteed. Coming back to my objective of retiring when I'm 50, that is a little while away and I won't be accessing that money for some time, so these short-term bumps in the road are of lower concern to me. Also, if I put away money each month towards this objective, and that is surplus to my lifestyle, i.e. I've budgeted for it and it will happen every single month, any short-term losses to the value of the pot do not affect my day-to-day finances or my material standard of living, so that would see me pushed up the risk scale. In fact, these short-term bumps might actually present an opportunity to buy at discounted prices, and I might even invest some more. Anyway, on to step 3. Step 3 is risk tolerance. The first 2 steps are financial calculations, they're number-based. Whereas this step 3, risk tolerance, is a psychological factor. How do you feel about taking risk? Ignore this one at your peril. If you do not consider your tolerance to risk properly, you can harm the chances of success for your investments by making adjustments to them at the worst possible time. I'll give you an example. Let's say you are naturally quite a risk-averse person. You're the kind of person that looks left, then right, then left again. One more time right, and then a few more for good luck. If you wake up one morning and your investments are down 30%, despite having a longer-term goal and a high capacity for loss, this may well still give you major anxiety. This anxiety might cause you to panic and sell your stocks at their lowest point in favour of sitting in cash as a safe place. And as such, you will miss out on any recovery, and it will have been a costly mistake. Investments go down as well as up. It's simply part of the journey. If you'd instead got a risk level that matched what you can bear psychologically much better, and say in that rough patch, instead of your investments falling by 30%, they only fell by 15%, and you could just shrug your shoulders, then that is a much better place to be and definitely increases your chance of long-term success. As this is so personal to you, it's very hard for me to relate something of merit with my own retirement goals. So all I can really tell you is how risk makes me feel. Now, I run my own business and would describe myself as a risk taker, so the downs and rough patches in the markets don't really bother me and certainly don't make me lose any sleep. Right, what's the final step? Step 4 is your knowledge and experience of financial products. This final step is all about what your previous experiences have been in relation to various types of financial products. What different financial products have you invested in previously, and did you do this having received advice from a professional, or did you go it alone? If you've done lots of investing before, are completely familiar with the ups and downs, understand the different options in the market, then you might feel more confident than, say, a first-time investor. What I would say on this one is this is probably actually the least important factor in assessing your overall risk appetite, as we all have to start somewhere, and it's as true to say that a new investor can take a high level of risk as well as a veteran be very conservative. So back to my goal. Well, I do this for a living, so I'm certainly up the experienced end of the scale. Well, I bloody hope so. So when you take all these factors into account, you would probably describe me as an adventurous or aggressive investor. And if you were to have a rummage through my investments, that's exactly what you'd find. We are all looking to mitigate risk wherever possible. The holy grail of low risk and high reward. But in reality, we know that that doesn't exist, as the two walk hand in hand. Don't forget, risk is a big term, and there are as many types of risk as there are days that I didn't fall out of the loft. From inflation to interest rate risk, currency to political risk, liquidity, credit, the list goes on. Investopedia says a low risk portfolio would contain something like 15 to 40% in stocks, a medium risk portfolio up to say 60%, and anything with more than 70% in stocks would be considered a high-risk portfolio, with the balance typically being made up of lower-risk assets like cash, property, etc. Morningstar actually have a rather useful article which will give you an indication of some different allocations at different risk levels, a link to which I'll leave below in the description. There's no gospel rule to go by here. I've had all sorts of rules thrown at me during my lifetime, like 100 minus your age is the percentage of stocks you should have in your portfolio, along with don't eat yellow snow. And the truth is, none of them have any base in facts. Well, maybe the snow one does.